Hello, welcome to this episode of Rich Insights. I'm Don Rich, the head of investments for Esoterica Capital Management. Today's topic is nationalizing our capital markets. Now, over the weekend, we had a lot of information unfolding. The most important piece of information was that Congress did not approve the $2 trillion bailout package that the market was expecting. Some would go even to say as far as the package that the market was promised. All right, so that didn't pass on the first go around. They're going to vote on it again today, and if it doesn't pass today, I understand Wednesday is the most likely time for the next vote. But you can't have a rainbow without rain. And we've certainly experienced our share of rain over the last month, since February 22nd, right? Since this turmoil all started. And markets are down again today, right? It continues to rain. So where's the rainbow at, fat guy? Well, we've got to have the stimulus package. There is no alternative. We have to get the stimulus package passed to calm the markets down. All right, so that was the first big piece of information over the weekend. That the stimulus, the federal, right, the government's, the fiscal stimulus package did not pass. Not yet. The other big piece of information was that we were given a heads up that Congress may allow the Fed to do more than they were previously allowed to do. All right? Congress may allow them to purchase long-term corporate debt for the first time. All right, so let's walk through this. A couple weeks ago, the Fed made a number of big moves, right? They announced a $700 to $750 quantitative easing program. They cut interest rates. They made a number of big moves. And we described that as a time as the Fed going all in, right? It was a kitchen sink moment. Well, how the hell are they able to top that then if they went all in? Well, they went all in with the tools that they had available to them at the time. The Fed was only able to hold government-insured assets. So that limited them to two asset classes: the Treasury bond market and government-insured mortgages, right? Agency-backed mortgages. So the Fed used all their weapons available at the time. Since then, Congress has given them more authority. All right, so my take on what's happened over the weekend is there's been some horse trading going on behind the scenes. The government has decided to allow the central banks to take care of the corporations, in large part. The central banks are going to be responsible for the corporations, and the fiscal package is going to be more focused toward the individuals and perhaps even small businesses. But we're going to see in a second, even the Fed now has some access to small businesses. But I think it was a necessary step because it's going to allow them to reconfigure the stimulus package more toward individuals, and that's going to be more palatable in terms of getting this stimulus package passed. Okay, so what happened? What happened in terms of the authority, the extra authority granted to the Fed? Well, the Federal Reserve is now going to be able to buy municipal debt. All right, this is debt issued by state and local governments. Now, before then, the Fed was really only able to provide liquidity, very short-term liquidity to the municipal market, to the munis. Now they're able to be a central player. They can play in the primary issuance market, all right? That's newly issued debt. So the Fed can buy newly issued debt, and they can play in the secondary market. That's the buying and selling of existing municipal debt outstanding. All right, and that's very important. That's very important. We know, we've said it many times, to kill the coronavirus, we have to kill the economy. That's the price we have to pay. the states and local governments are going to have to issue a tremendous amount of debt. The government is too, right? We got federal debt coming, no doubt about that. But state and local economies are also going to have to issue a lot of debt, right? And we need liquidity. We need that market place to operate efficiently. And this is a major step to improving the liquidity and the efficiency in that marketplace. So that was the first step. The Fed's going to be able to play in the municipal bond market. Now, in the corporate bond market, the Fed can play in the primary debt issuance, right? Buy newly issued debt by U.S. corporations for the first time. And they can play in the secondary market. Again, just like for munis. All right. And this covers all the investment grade bond market. All right. Not high yield. High yield's not part of this. Junk bonds are not part of this. Right now, we're only limited to high yield. We're limited to investment grade. But remember, investment grade, we have the triple A's, the double A's, the single A's, and the triple B categories. All right, those 4 categories. And with each category, we have triple B plus, triple B's, and triple B minuses. So the Fed can go all the way down to buying triple B minus level securities. Now remember, 50 to 60% of the investment grade bond market is in this triple B category. So this is going to provide a lot of help to a lot of companies. All right, this is really important. So the Fed can, for corporate debt, the Fed can play in the primary market, secondary market, and there was a third step to it. The Fed can buy ETFs. All right. Now let's go back. We told you some 3 or 4 weeks ago that this was coming. The ECB, right, the European Central Bank, had been purchasing corporate debt for a long time. The U.S. Federal Reserve was not allowed to. So we told you this was coming. That's what we're seeing today. Now, we also told you a month ago that at some point, the Fed is going to be allowed to actually purchase equities, buy U.S. stocks. Right? They're able to do that in Japan right now. The Bank of Japan is able to do that. They're the only central bank in the world that right now is able to purchase equities. But it's coming. That's coming as well. Now, with that comes a whole host of issues. Right? When you think about buying corporate debt, which corporate debt are you going to buy? Are we just going to buy GE bonds or Boeing bonds or maybe airline bonds? Bonds issued by airline companies, because all these areas are in trouble right now? Well, the answer is yes to all the above, but the Fed is also able to purchase ETFs. All right. Now, all ETFs are actually listed as equity securities. All right. This isn't the monumental phase when I said eventually the Fed is going to be able to purchase equities. All they're able to purchase is fixed income ETFs. All right. Even though ETFs are considered equities, they're only able to purchase fixed income ETFs. Right. Corporate bond ETFs. And the most popular in that category is something called the LQD. That's the ticker, LQD. This is a BlackRock iShares ETF. It's a cap-weighted index of the entire U.S. bond market. Now, when Japan buys equities, they don't just buy shares of Toyota or Sony or some of the most well-known Japanese names. Right? That would be unfair. What they buy is an ETF of the entire Japanese stock market. All right? It's a cap-weighted index of the entire Japanese stock market. So that's what we're talking about now in the U.S. The Fed's going to be able to purchase the ETF of the U.S. bond market. It's going to be cap-weighted. But there's a big difference here. Because when you purchase cap-weighted equities, the biggest firms get a disproportional advantage, right? Favoritism. They're the biggest. They got the largest market cap, so they're the biggest benefactors. Well, in the bond market, when you purchase a cap-weighted bond index, It's not the biggest and the best firms that get rewarded. It's the firms that have the most debt outstanding. The firms that have issued the most debt are the ones that have the highest representation in a cap-weighted bond index. So what that means is, to some extent, to a large extent, is those firms that have behaved most poorly in the past, that bad behavior is going to be rewarded. They're going to be the biggest benefactor of this move by the Fed today. All right? That's bothersome. That's bothersome. All right? The whole concept, what we're talking about here, is nationalizing the markets in the first place, right? That's bothersome. We're taking the private markets and we're putting them under state or country, federal control. All right? The price setter, very quickly in the U.S. bond market, the main price setter is going to be the Federal Reserve. Government appointed employees are going to be the price setter in the marketplace. That scares the hell out of me. Plus, the potential favoritism or the rewarding of bad behavior in the past also bothers me, scares the hell out of me. But let's be clear. Right now, this is a necessary action. Right? The ship is taking on water, and we have to do whatever we can do. No matter how much I may dislike this, I am 100% behind this right now. All right, the old phrase, when you're combining, you don't stop because you see a pheasant's nest. When the house is on fire, the antique sofa is not your concern. Right? Your primary concern is to save as much of the house as you can. That's what's going on here today. So we have to accept that we are going to be rewarding some players that we probably shouldn't have in the past. All right, the other major event that came out of the Fed still has to be worked out is apparently the Fed is also going to be able, they call it the Main Street Initiative, the Main Street Facility. The Fed is going to target small and medium enterprises. They call them SMEs. All right. Now, how they're going to go about providing liquidity, providing credit for small and medium-sized businesses, they still have to work this out. All right. But that's also another meaningful step that the Fed's taken. But near as I can tell, again, to pull back at 30,000 feet, the horse trading that went on behind the scenes was we've decided that the central bank, the Federal Reserve, is going to be in charge of handling the corporation's problems and deciding who the winners and losers are going to be. The government fiscal package is going to focus more on the individuals. All right, that's our message for today. I'm Don Rich. You've just experienced a rich insight. I hope you've enjoyed it. May your beer be colder than the company you keep. We'll talk again soon. Thank you.